Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are solving a past paper question. If you have the Kaplan kit, this is question number 303 in your Kaplan kit. However, I highly recommend that you practice this question on the practice platform itself. So as you can see it in front of you, this question was asked in the March-June 2022 exam. So all of the past papers are important for you to practice by default. So without any further ado, let's get started. The requirements, as you can see on the right hand side of the screen, the proposed, so there's some investment that they're planning to make. So we have to work out the NPV, the IRR, the payback period, as well as the ROCE. So the marks are also written by the side, and this is all that we have to work out. So now I know that all of these things are something which I'm supposed to calculate. So whenever I'm reading this entire long case study, I'm going to, keep in mind that what all could be useful in my calculations. So the first, I'm starting to read the paragraph. So Melplash company manufactures motorcycles and is considering an investment in a new high performance model. The market for high performance motorcycles is very competitive, and Melplash company's directors want to recover the costs of the initial model quickly. So before it is made obsolete by more advanced models at the end of 4 years. So now I know that the life of my project is 4 years. The directors also wish to show the shareholders that the investment will be profitable. So the directors have therefore set a target payback of 2 years. So this is what they're thinking of the target to be, and the target return on capital employed to be 20%. So this is what targets they have set. And the directors have also asked the finance director to provide the NPV and the IRR calculations for the investment. They plan to consider the results of these calculations if the investment fulfills the payback as well as the ROCE targets. So here they have given you the production and sales forecasts for all of the 4 years, and then you have more information, and at the end it's mentioned that we are supposed to ignore taxation over here. So let's get started now for the proposed investment. All right, so the first part that I have is net present value, which is for 5 marks. So let's begin calculating for that. I'm using the constructed response workspace for my answer. So this is part A and this is part I. So NPV is something which I'm supposed to calculate over here. So my first, I'm going to prepare a rough layout for my working. So I'm going to write the years first. 1, 2, 3, and 4 are my years. And then initially I do start with the revenue figures. So for the revenue figures, I will first need my number of units. Number of units are readily given to us in the question, as you can see here, 25, 45, 40, and 20. So 25,000, 45,000, 40,000, and 20,000. So these are my number of units. Now for the sales price, the information is in the table below. So the sales price is given to me in year 1 price terms, which means 20,000 is the selling price which is going to apply in year 1. So this is my selling price in the first year. Now when it comes to the second year, it says that there's going to be an inflation of 6% per year. So on the initial price of 20,000, I'm going to have to apply an inflation of 6%, which means I can say that 1 into 1.06. So this is how I can apply the inflation and bring it to the rest of the cells as well. So now I have my revenue calculated, which is nothing but the product of my number of units and the selling price per unit. So with this, you have your revenue. Just expand the size of the cells so that you're able to see the entire figures. Now, this is how you're supposed to work out the revenues. You can just expand the cells a little bit so that the entire, content is visible. So now we do have our revenues all worked out. Now the second step is that we're supposed to subtract the variable costs to obtain our contribution. So the variable cost again is given to me in year 1 price terms, which is $14,000 per motorcycle. So this is nothing but 14,000 in the first year, and then eventually in the coming years it's going to be an inflation of 6%, which gets applied to the first figure, so into 1.06. And then you can also drag this formula to the remainder of the cells. Now, this is your variable cost per unit. You also need to find out the total variable cost. So the total will be nothing but the cost per unit multiplied by the total number of units. So again, if you just drag this to the remainder, you have your total variable costs. And now the difference between your revenue and your variable cost is going to give you your contribution. So my revenue and my variable costs are something which I've added over here. So with this, I arrive at my contribution. So now the next step which I have over here is going to be to, subtract what is going to be my fixed cost. So my fixed cost over here is given to me at $120 million per year. Now be very mindful. We are taking incremental fixed costs because these are the fixed costs which arise directly due to us taking this project. Otherwise, if these were general fixed costs which would anyway be incurred, then this would be irrelevant and we would not be taking this in our calculations. But because it is mentioned that these are incremental fixed costs, that is why we are going to put them in our calculations. So the first one is given to me as $120 million per year. So I've input $120 million and then I'm going to apply an inflation of 10% to this figure over here and then drag it to the remainder of the years as well. Now the difference between the fixed cost and my contribution is going to give me my cash flows before tax. Now over here I do not really have tax, so before and after tax will be the same. So this and this. Again, you can drag this to the remainder of the cells. So now you do have your cash flows with yourself. Now, one more thing which we are supposed to do over here is that we need to account for the initial investments as well as the residual values because we do not have any tax and we do not have any working capital. So this is our last step, initial investment and scrap value. So my initial investment goes out today, which is year 0. So I'm going to put a minus 220 million here. And then eventually in the last year, I'm going to sell, whatever is left in the machinery or whatever I'm acquiring the project. So the value that I get at the end is $30 million. So this is money coming in. Hence, I add this, I show it as a positive inflow. So this is 30 million right over here. And now I can have my net cash flows. So my net cash flows will be the sum from here to here. Again, this can be dragged to the remainder. So you do have your net cash flows. Now, these are the cash flows over which you will apply your, discount rate to obtain your net present value. So NPV, you can straight away use the NPV formula equals NPV. Select all values from your 1 to 4. And then you manually subtract the initial investment in year 0. So this is what I've selected. And then I add this value over here. I don't know why this is not working. Let me just, because I'm not putting the discount rate. So equals NPV, and I want the discount rate to be 14%. So 14%, and then I put a comma, and then I select all of the cash flows from year 1 to year 4, and then I manually add the year 0. So with this, I arrive at my NPV. My NPV, as you can see, has come out to be roughly $16.79 million. If you use the discount rates from the annuity tables, you're going to get a slightly different answer, and that is completely all right. So with this, we are done with the first part of our question, which is worth 5 marks. Now let's move ahead where we need to work out the IRR. So you do not need to do a lot over here. You already have your cash flows. So it's primarily the formula that you need to put over here. So equals to IRR. And over here, now you select all of your values right from year 0 to the last year, which is year 4 with you. So, and then you hit enter, and then you arrive at your IRR. You just convert it to a percentage format, and then it gives you your IRR of 17.7%. If you again use, some the discount factors using the tables which you have, calculating two NPVs using the interpolation method, you'll get a slightly different answer, but that variation is completely all right. So this was a relatively easy part. Now third part wants you to calculate the payback period for 1 mark. So let's do that. So if you see in year 1, what's going to happen is, basically these are all of your cash inflows. I'm just copy pasting these values over here. I think this is not working here. So if I just copy and perhaps try to do a paste special, let's see if this works. Paste special values. So just paste special values over here, and then you will have the values that you want. So these are your cash inflows for all the years that are being in question over here. Now, what you really have to do is that you need to recover you need to find out the time that it is taking for you to recover the initial investment of $220 million. So if you see, you're recovering roughly $30 million, exactly $30 million in the first year. So you know that the first year is totally going away. So let's do it through the cumulative way. So if I just take the cumulative way, it's in year 0, I'm spending out money. Now in year 1, I've already spent 220 in year 0. Now in year 1, I get 30 million back. So in net, now I am left with 190 million more to recover. Now in the next year, I recover some more money. So I add this to my total, which makes it 35.8 million more to recover. So now I know 2 years it's going to take completely for me to recover, and then some additional time also. So if I take this negative figure and I add the cash flow that I'm receiving in the third year, I am getting a positive figure over here. But if you see, after the second year has passed, I'm only left with $35.8 million to recover. So now I have to find out exactly in how much time am I getting back the entire, money that I'm supposed to receive. So we all know that 2 years it's complete, but the third year it's only a portion of the third year. So how do you find out the portion of the third year that it is taking you? So you take nothing but 2 as complete, and then to find out the remainder of the decimal, this is the money that you are left with to recover. So this becomes your numerator, and then you divide this with your denominator, which is going to be the sum of this 35, and then the value that you have over here. So if I just so let me write it as absolute over here, right? So 2, it's definitely going to be, and then for the how much portion of third year it is taking, so this becomes your numerator. You divide that by the total, which is this that you want to recover, plus the additional that you are actually recovering in this time period. So what you get is the remainder of the time which it is taking you to recover your initial investment. So you can say that it's roughly taking you 2.29 years or you can also say 2.3 years roughly. And if you just multiply this by 12, you will get the number of months also. So it's roughly taking you 2 years and 3 months to recover your initial investment. Now, this is how you can calculate your part 3. Now, let's move ahead to part 4. Part 4 wants you to find out the return on capital employed, which is based on the average investment. So, there are a couple of things which we need to work out before we can use the ROCE formula straight away. So, let me first find out how much my profits are. So, if you see the cash inflows that we are having, these are all of the cash inflows that we have with us. It's 30 million, 154.2, 124.4, and then you have 13.2 million which you are having. But the 13.2 million which you have over here also includes the scrap value coming in. This is not a profit, but this is the money that you are generating because of selling an asset. So this is not technically profit. So this 30 million needs to be subtracted from here. So what we can do is, firstly, let's work out the total inflow. So the inflow is nothing but the sum of these values. And then for the same reason that I told you, I'm subtracting 30 million from here because those are sales proceeds from the sale of an asset and not technically profit. Now let's see how much depreciation has been, there. So our main expenses over here is depreciation. If you just subtract the depreciation portion from the inflows that we have calculated, we'll arrive at the profits that we have. So if you see, 220 million is what we got this machine at, and 30 million was its scrap value. So the remainder, that means $190 million was the depreciation that we had in it. So if we see the total profit is going to be the difference between my inflows and my total depreciation. So this has been my total profit. Now, if I want to calculate the average profit, this profit I've earned over a period of 4 years. So if I just divide this by 4, I'll have it in annual terms. Now, the next thing that I need to work out is my average investment. So my average investment is nothing but the initial value plus the scrap value divided by 2. So initial value is 220 million. And then the scrap value is 30 million. And if I divide these by 2, I will have my average investment, which comes out to be $125 million. Now I can use the ROCE formula in which I have the numerator as the average accounting profit, and then I have the denominator as the average investment. So you hit enter and you convert it to a percentage. So roughly 20.37% is your return on the capital employed. With this, we are done with the part A. Now let's move ahead. Part B wants you to discuss the suitability of the techniques used in Part A for determining whether to undertake an investment and advise whether Melplash Company's proposed investment is financially acceptable. Now, this part itself is for 9 marks. So, basically, what you got to do over here is that for all of the methods that you have calculated, you need to talk about them. You need to talk about the decision rule, how they are calculated, what do they show, and whether they are meeting the targets that the directors have set or not. So this is how you comment on them. And then lastly, you give an advice also regarding the financial acceptability. So let's go back to the numbers so that we know what all we can write about it. So the very first thing that we had worked out was the net present value. So basically what we say about NPV is going to be that, we are, NPV is a measure which shows the exact absolute increase in the shareholders' wealth if the project is undertaken. So, NPV calculation again also depends upon what cost of capital we are taking. So it's only valid, whatever we calculate the NPV as is only valid if we have taken the correct cost of capital. So, if the options which the board is currently thinking about are mutually exclusive, that means only one option will be taken, otherwise the other option will be taken. So NPV can be used to give a ranking over there, because it is indicating how much shareholders wealth will increase if the project is undertaken. So this is how NPV will be used over here. Also, you can comment that since the NPV is a good positive figure, the project can be gone ahead with. Then the next thing that we worked out was the internal rate of return. So basically, you will talk about what IRR does. It gives you the return that the project is generating, basically the rate at which your NPV becomes zero. So again, over here you'll talk about how when it comes to non-conventional projects, IRR can give you multiple decisions, multiple rates of return, and how difficult it can get to compare that, which IRR should you compare with the cost of capital. So over here you can say that in our scenario we have gotten just one IRR, which is 17.7%, and which is higher than our cost of capital of 14%. So from the perspective of your IRR, the project is acceptable. Then if I talk about the payback period, which we calculated on the third position, so you first talk about what payback does. So basically, it tells you the time period that the project will take for you to recover your initial investment. So over here, if you see that the time in which we are getting our initial money back is exceeding 2 years, it's more than 2 years, 2.3 years. So probably the directors are going to reject it on this basis. But the fact that they are ignoring the total return on the investment, and also the payback method is not considering the time value of money. So these are a few limitations basis which the directors should not be rejecting the project and should be considering other factors also. Now let's talk about the fourth perspective, which is the return on capital employed. So you will tell how the ROCE tells you how much the company is generating over the investment, how much return is it getting, how much return is it making. So if you see that the target that they had given us for the ROCE was 20%, and the investment is giving you slightly more than what your target was, which is 20.4% if I round it. So with this measure, they can possibly go ahead with this project, but it is a percentage measure. So it does not indicate how much exactly the wealth of the shareholders is going to increase. So this is how you can frame on the perspectives of all of the four things which we have calculated. Now last statement should be a conclusion with a general advice. So you can say that the investment is acceptable using three of the four methods. All methods are acceptable apart from the payback period, because that is exceeding our target. So the directors should probably go ahead with this investment, because there's a positive NPV, and in the long term the shareholders wealth is going to increase. Otherwise, if the directors are facing issues, they think that there's going to be uncertainty, then they can perform a sensitivity analysis, and basis the results of the analysis, they can take a decision of whether they want to go ahead with the project or not. So this is how you will frame your answer for the part B. Make sure that you're writing enough depth, enough explanation for it to be, something which is worthy of securing 9 marks. With this, we have come to an end to this question. I hope that this was useful. And if you want me to solve any more questions, you can leave a comment down below. Thank you so much for watching. All the best.